Thanks for having me. So I'm Brian Estes. I'm the CEO and CIO of Off the Chain Capital. What we're going to do today is a Bitcoin and blockchain educational class. Should take about 35 minutes to go through these slides. And the purpose is to help educate you on why Bitcoin's important, why blockchain's important, why do you add it to an investment portfolio, and the benefits of doing that. Off the Chain is an SEC registered investment advisor. So I'm not going to read this to you, but basically what this says is that we'll be talking about what are called forward-looking statements, and don't rely on these statements as investment advice. You need to seek your own professional investment advice from your financial advisor. So I started in traditional finance 30 years ago, back in 1991. Before that, I did traditional education, University of Illinois, did my study abroad at Cambridge University, London School of Economics, MBA from WashU. Like I said, spent over 20 years in traditional finance. But back in 2014, I learned about Bitcoin and blockchain. I decided to sell my company, and so I sold it to Wells Fargo Advisors. Took that capital and started building blockchain companies back in 2014. And over the past 8 years, I've helped build, finance, and mentor a number of blockchain companies that, if you add them all up, they're well in excess of $100 billion today of value. And so what I'm going to do today is talk about some of the lessons that I've learned over the past 8 years, so that you don't make the same mistakes I made. And hopefully this will help you understand how to make money in the space going forward. So to get started, here's a quick agenda. We're going to spend a few minutes on the history of money, like the basics of money. We'll talk about Bitcoin as an innovation. Why does Bitcoin have value? Why add Bitcoin to a diversified investment portfolio? We're going to go through our models on how to value Bitcoin. Everybody knows what the price is, but what's the value of Bitcoin? And so we're going to go through those models, and then we're going to talk about some of the risk and regulations around the industry. So let's start with a brief history of money. So we as humans, about 10,000 years ago, we lived in tribes of between 100 and 150 people. And so whatever the local scarce commodity was in that area, that's what we used as our money, as our store of value. So you would go out and work or create value for other people by making things, and then the central point of money was to store that value that you created. And so for some communities it was shells, for others it was salt or stones. But the problem with that is that if one tribe went like 20 miles and tried to do commerce or trade with another tribe, and one was using shells and the other was using stones, it created too much friction in trying to do that commerce. And so what we as humans decided collectively about 3,500 years ago is to use like gold and silver as our money. And so we've been using that up through 1971. And so we started with gold and then gold coins. And then in the 11th century, about 1,000 years ago, the Chinese invented paper money. And paper money was the new technology because it was more divisible and more portable than gold. And so you would have a depository that would hold your gold, and then they would issue out paper notes on that gold that were convertible back into that gold. And that paper money, like I said, it was more portable and more divisible. And so that allowed commerce to increase. And then about 500 years ago, the Medici family over in Italy started using what's called double entry bookkeeping. And double entry bookkeeping is what created the bond market and the banks. And so, what double entry bookkeeping is you have a ledger, and on one side you have credits, on the other side you have debits. And then as you move money back and forth across that ledger, then that's how you move the money. So if you have one bank, like say Bank of America, they have their own ledger, and I need to transfer money from my Bank of America account to Michael's JP Morgan account. The JP Morgan account and the Bank of America ledgers have to come together and reconcile with each other to move that money. Okay, so what Bitcoin is, and it's that same ledger technology we've been using for over 500 years with a little twist. So instead of having a Bank of America ledger and a JP Morgan ledger that have to reconcile, what we have is one universal ledger, which is Bitcoin. And so all the value is held on the Bitcoin network. And as we move money back and forth between like me and Michael on the Bitcoin network, there's no reconciliation that's needed. It's one universal ledger that's open source that anybody could view in the world. And that's what creates the trust in the system. It's just like if I hand Michael a $20 bill and Mike's holding that $20 bill and I'm not, then that's Michael's $20. It's not mine anymore. So it's the same thing with the Bitcoin network. If I move one Bitcoin from my side of the ledger to Michael's side of the ledger, that's a permanent transaction on the Bitcoin blockchain that can't be reversed. And so the whole world could see that Michael owns that Bitcoin now. And so, that's Michael's Bitcoin. It's not mine anymore. And so that's why Bitcoin's so important. It's one universal source of truth for value on the internet. So just a little brief history about money again is, like I said, 10,000 years ago, we were using shells, salt, and stone, then gold, and then the paper notes, and then the bond market. And then about 50 years ago, what happened was that President Nixon took the United States off of the gold standard. And so that was in 1971. So since 1971, our money hasn't been backed by gold anymore. And so what that means is that, our money is basically being based on like faith and, in the US government. And, trust in the government has been declining, especially over the last few years. And as trust declines in the government, trust also declines in our money. And the fact that the government keeps printing more and more money, looks like the system's broken. And in my opinion, I think what's going to happen is that this experiment that we've been going through for 50 years, where our money's not being backed by anything, is failing. And we're going to revert back to a hard money system. And we're either going to go back to a gold system, or we could go to a Bitcoin standard, because Bitcoin is actually a better version of gold. So before there was Bitcoin and before there was a blockchain, there was a problem with the internet. And so Milton Friedman identified this problem back in 1999. And so what he basically said was that there's no way for person A to transfer money to person B without those two people knowing each other, or without a trusted third party to clear those transactions. And so that was the problem with the internet. When we built it 30 years ago, there was no way for us to transfer value through the internet unless we used like a bank or Visa, MasterCard, or like a PayPal. And so Elon Musk, most of you know who Elon Musk is today, Luke Nosek, and Peter Thiel, these three people started a company called PayPal back in 1998. PayPal's original mission back in 1998 was to create Bitcoin. They wanted to create that software that allowed the transfer of value through the internet without a trusted third party. And so, this new currency would be independent of interference from banks and governments that were debasing their currency. So that was their original goal. When they started PayPal, they couldn't figure out how to create that software. And so PayPal back in 1998 got defaulted to the US dollar because they couldn't figure out how to create the software, the blockchain software that we have today. Even back in 1992, Mark Andreessen, who started a company called Netscape, tried to figure out that software too. He tried to create software that allowed us to send value through the internet. He couldn't figure it out either. And that's why today he says that blockchain is the most important technology since the internet itself. Because what we're doing is we're rebuilding the entire internet today on blockchain technology. We're taking it off of the bank, credit card, and PayPal system that was established 30 years ago because we built it wrong 30 years ago. The internet was built incorrectly because no one could figure out how to create the software that allowed us to do peer-to-peer transfer of value through the internet. So what we're doing today is we're rebuilding the internet on blockchain technology. And that's why Mark says this is the most important technology since the internet itself. So what is the Bitcoin blockchain? Basically, it's open source internet protocol software. So that may sound confusing to some of you, but you use open source internet protocol software every day. You know, if you go on the internet, you're using what's called HTTP. HTTP is Hypertext Transfer Protocol. If you send an email, you're using SMTP, Simple Mail Transfer Protocol. Both of those are open source internet protocol software packages. And that's what Bitcoin is. It's just another version of open source software for the internet that allows this transfer of value through the internet on a peer-to-peer basis. And the way it does that, it solves what's called the double spend problem. So the double spend problem is the fact that if I have a digital good on the internet, I could copy and paste it and send it to multiple people. So I could send multiple copies. But with money, you can't do that. You know, I can't double spend the same money. And so what this software does, what the Bitcoin software did, was it solved that double spend problem. And the way it did it, it created a public ledger that was distributed around the world and updated every 10 minutes. And what this enables is that peer-to-peer transfer of value through the internet without having a trusted third party clear that transaction for us. So here's another way to look at it. You know, we talked about SMTP, HTTP. You know, we see Bitcoin as the final piece of the internet protocol puzzle. But what Bitcoin is really like are domain names. So domain names have value because there's a finite supply of domain names on the internet. There's only one Amazon.com or Nike.com. And so because of that, when there were only a few 100 million people using the internet 30 years ago, those domain names weren't worth very much money. But today, when there's billions of people using the internet, those domain names are priceless. You know, there's a lot of domain names that, you know, like what is Amazon.com worth? So you could think about Bitcoin the same way. With Bitcoin, there's only 21 million Bitcoin that could ever be created. And so there's only about 200 million people using Bitcoin today. But when there's billions of people using Bitcoin in the future, that 21 million Bitcoins will be worth a lot more than it is today. So that's the general way you need to think about creating value with Bitcoin. So let's look at the Bitcoin economics. So Bitcoin is software, and in that software, it says that there will be a maximum 21 million Bitcoin that could ever be created. 19 of the 21 million Bitcoin has been created today. So 90% of the Bitcoin has already been created. It's going to take 120 years to create that last 10%. And so that's the supply of Bitcoin. It's fixed, it's hard-coded into that software. It could never change. So if we look at the demand for Bitcoin, since 2012, looking at the number of wallets, the number of wallets has grown at over 500% per year. So if you have demand growing at 500% a year and you have a finite supply of an asset, the only other variable that could change is the price. And that's why Bitcoin keeps going higher and higher and higher. And that's why it's been the best performing asset 11 out of the past 13 years. It's all based on the demand exceeding the supply of Bitcoin. And so if we look at internet adoption versus crypto adoption, so the top is the 90s, the bottom is like 2014 to year 2024, and we overlay crypto versus internet. You could see that the internet adoption and crypto adoption are both growing at the same rate, a very high rate of growth. Another way to look at this is based on what's called SCurve analysis. SCurve analysis is the way you value blockchains, or excuse me, the way you value new technologies like blockchains. And so new technologies back in the 1800s were railroads. In the 1940s, it was cars. In the 1970s, it was fax machines. And so anything that's a new technology, you could apply S-curve analysis to determine when it becomes mass adopted. So back in 2009, Bitcoin was invented. By 2019, 10% of US households own Bitcoin. Today it's 25%, and using SCurve Analysis, this tells us by 2029 that 90% of households in the US will own Bitcoin. So now is now's the sweet spot. Now's the time you want to invest, is when we're on this mass adoption. If you wait till we're at 90% adoption, then the opportunity has passed. So a lot of people ask, like, have I missed it? Bitcoin went from hundreds of dollars to $40,000 today. And the answer is no, you haven't missed it. We're still in the early stages of adoption of Bitcoin. So right now, the cryptocurrency market only represents about 2% of the total addressable market when we compare it to global bonds, gold, money supply, and digital payment networks. If we compare it to the S&P 500 and global stocks, it's even smaller if we add that in. So what does the government and what does the Federal Reserve say about Bitcoin? Well, Bitcoin provides diversification, and we know that because the Federal Reserve Bank of St. Louis said so. Back in January of 2018, so over 4 years ago, they came out with a white paper. And in this white paper, it says that Bitcoin will emerge as its own asset class and thus have the potential to develop it into an interesting investment and diversification instrument. The reason they say diversification instrument is because it's a non-correlated asset. So I just want to make sure you understand when I say it's non-correlated. I'm not saying that it's negatively correlated. A lot of people think that Bitcoin's negatively correlated. What that means is if the stock market goes down, Bitcoin will go up. I'm not saying that. Bitcoin is not negatively correlated. It's non-correlated. And what non-correlated means is that if the stock market goes down, sometimes Bitcoin goes up, sometimes it goes down. There's no rhyme or reason to Bitcoin's movement with traditional asset classes like stocks and bonds. And so we could see that in the data. So over the past 5 years, if you take a portfolio that's 60% stocks, 40% bonds, that's classified as the typical portfolio, that return would have been about 11% per year over the past 5 years. The volatility would have been 7.28%. And the maximum downside that portfolio experienced was 21.6%. If we just take a little bit of that money and put it in Bitcoin, so you have 58% in stocks, 40% bonds, and 2% in Bitcoin, the return on that portfolio went from 11% to 13.5%. The volatility barely changed, and the maximum downside actually was less with Bitcoin in the portfolio. And so the way you measure risk on a portfolio is you use what's called a Sharpe ratio. These are risk-adjusted returns. And so by adding a small amount of Bitcoin, which is non-correlated, to a diversified portfolio, actually increases your Sharpe ratio. It increases your risk-adjusted returns. So every unit of risk that you're taking, you're getting more in return. And so as fiduciaries start to understand that adding small amounts of Bitcoin to a portfolio increases their Sharpe ratio, they're more likely to add to it, add to this asset class. And that's what we see starting to happen today. So like I said, Bitcoin's been one of the best performing asset classes. If we take a look at, over the past few years, you can see that there's only 2 years that, it did poorly. And the rest of the years, it was the #1 performing asset class. Another way to look at this is let's compare risk analysis, risk-adjusted returns, versus other competitive assets like Tesla, Google, Netflix, Apple, Amazon, and Facebook. So the bottom left-hand corner, you see a gold dot. That's a portfolio of 90% Bitcoin, 90% cash, 10% Bitcoin. And so if you take that and move it up to the upper right-hand corner, we have a portfolio of 100% Bitcoin. And all we did is draw a line connecting the 10% Bitcoin, 90% cash to the 100% Bitcoin. So that's our risk-adjusted line. And we want to compare that to, stocks, the high-performing stocks over the past 10 years. So we plotted in there like, like I said, Facebook, Amazon, Apple, Netflix, Google, Tesla. So the portfolio of 10% Bitcoin, 90% cash outperformed all those stocks except for Tesla. You would have to have 30% Bitcoin, 70% cash to outperform Tesla. And so it's very interesting to see that, by actually having a conservative portfolio of 10% Bitcoin, 90% cash, that actually outperform these high-flying stocks. The other thing to look at too that's interesting is that a portfolio of 10-year treasury bonds is in the bottom left-hand corner. So that portfolio compared to 10% Bitcoin, 90% stocks, the portfolio of 10% Bitcoin, 90% stocks, we're expecting that it did better, which it did. It averaged, about 40% per year versus less than 8% for the 10-year treasuries. But the interesting fact is that it actually did it with less risk, less volatility. There was less volatility in a portfolio of 10% Bitcoin, 90% cash than a portfolio of 10-year US treasuries. So who's starting to adopt this asset class? Large institutions are. So, some of you may have heard of MicroStrategy. They've bought over 100,000 Bitcoin for their balance sheet. You see Citigroup, Square, Tesla, Goldman Sachs, JP Morgan, Fidelity, Ameren, which is the electric utility company in the St. Louis area, PayPal, MassMutual. They're all getting involved in this blockchain industry. So what we're going to go through next are models. So these are how we value Bitcoin. This is our most basic model. This is just basic trend line analysis. What we do is that we take the historical price of Bitcoin over the past 12 years and plot it out on a logarithmic scale and run a linear regression through the center of that. And so what this says is that based on trend line analysis, is that Bitcoin should be worth about $84,000 today, and it's worth about half of that. And this model is 91% correlated to the historical price of Bitcoin. So this model is telling us that Bitcoin is undervalued today. Another model that we use is based off what's called Metcalfes Law. Metcalfes Law is how we value networks like Facebook, eBay, Google. And so these, using this network value where we square the number of users and multiply the transactional value going through the network, this model shows that Bitcoin should be $48,000, and right now it's worth about $40,000. So this is another model that says that Bitcoin's undervalued. The third model that we use, it's called a stock to flow model. So stock to flow models are used to value commodities like gold, diamonds, palladium, platinum. And so based on this model, which is 95% correlated to the historical price of Bitcoin, this model says that Bitcoin should be worth about $100,000 today, should be worth $1 million of Bitcoin in 2025, and should be worth $10 million of Bitcoin in year 2029. The last model that we use, it's that same stock to flow analysis, but what we do is we take out dollars, take that out of the equation, and substitute gold as the monetary unit of measure. And so what this model says is that Bitcoin today should be worth about 100 ounces of gold, and it's only selling for about 25 ounces of gold. So it's 75% lower than what it should be. And this model also concludes that in 2025, one Bitcoin should be worth 1,000 ounces of gold. And in 2029, one Bitcoin should be worth 10,000 ounces of gold. Well, 10,000 ounces of gold today is worth about $18 million. And that's what this model is projecting, is that Bitcoin should be worth around 18 million by 2029. So Bitcoin comes with volatility. That's the price that you pay for owning a fast-growing, high-growing asset class like this. It's normal for Bitcoin to drop 30 to 50% in a very short time period over a month or two. Like I said, that's normal activity for this asset class. But if you are able to hold Bitcoin for the longer term, like say a 2-year period, The 2-year periods, Bitcoin's always up. It's just over the short run, over a month or two, sometimes it goes down 30 to 50%. So the last thing I'm going to talk about is there's a lot of chatter out there about the government's want to ban Bitcoin. And our data doesn't show that. The SEC, Chairman Gensler, just a few months ago said, the SEC has no plans to ban crypto. Jerome Powell, the commissioner of the president of the Fed, or chairman of the Fed, says that, there's no intention to ban them, talking about crypto. And then Brian Brooks, the former comptroller of the US currency, said publicly, nobody's going to ban Bitcoin. And the reason they said that is because they can't. The government can't ban Bitcoin. And the reason is that back in 1996, there was a case that went all the way to the Supreme Court, Bernstein versus the Department of Justice. In this case, there was a company that wanted to export cryptographic software outside the US. The Department of Defense said, we don't like that, national defense issues, sued them. The Department of Justice took up the case and they lost. So the Supreme Court decided back in 1996 that computer code is speech and it's protected speech under the First Amendment. So there's no way the US government can outlaw Bitcoin. But what they can do is tax it to death. They can slow it down by regulating it to death. And so that's what they're doing. They're taxing it and regulating it, trying to slow it down, but they can't stop it. So the last slide I have here is like why take your hard-earned money and convert it from dollars into Bitcoin? Well, first of all, it increases your risk-adjusted returns and increases that Sharpe ratio for your portfolio. It's the next new megatrend based on SCurve Analysis. And this megatrend, very few people know about. Only about 1% of the world today owns Bitcoin. And then about 25% of US households own it today. So we're still very early. It increases the portfolio performance of your investments. It's a misunderstood asset class. And what I mean by that is that just people don't know what it is. You say Bitcoin to them, and a lot of people, their eyes glaze over. What Bitcoin is software. It's software that allows us to fix the internet that we created 30 years ago, incorrectly. And so we're rebuilding the internet so that we could do peer-to-peer transfer of value through the internet so that we don't have to use a bank or a Visa or a MasterCard to clear those transactions. And why is this important? Because it protects you against economic uncertainty as we transition from this experiment that we've been in for 50 years into a more stable financial system. And as that transition occurs over the next 5, 10, 20 years, you need to have ownership of your property, and Bitcoin is ownership of your digital property. And so I'll conclude here. If you have any questions or would like a copy of this deck, you could email our team at lp@offthechain.capital, and we'll be glad to send you a copy of this deck.
Brian, you have a couple questions up here.
Okay.
First one was someone who's a fan of your audiovisual presentation, wanted to know if it was possible to know the general estimate of that. And then the other one.
Oh, the estimate of doing the show. Yeah. So we did that at the Temple House in Miami. So the Temple House is a converted Jewish synagogue that they turned into a projection mapping space. Mm-hmm. And so you hire their team there to go in and you tell them what you want. And we wanted to turn this into like a metaverse. Mm-hmm. So they had different price points for that. So ours was on the high end of that. But yeah, I would contact the Temple House. There's a lady named Ariel that could help you out there, and she'll help you actually build what we built. You give her your vision, and she has a team that will help build the graphics for you.
Wow. All right. Vishal wants to know any thoughts on Bitcoin's correlation versus NASDAQ over the past 3 years. The peaks and troughs align fairly well with liquidity markets.
Yeah, in the short run, Bitcoin is highly correlated to the stock market, like like the Nasdaq or the S&P 500. So over a 1 day or 1 week period, it's highly correlated. Over months, quarters, and years, it's not correlated. Bitcoin's correlation to the S&P 500 over the past 2 years has been 0.39. And if you look over the past 5 years on a monthly basis, the correlation is like 0.0, I think it's 0.02 or 0.06. So it's a non-correlated asset. It's becoming more and more correlated over time as more and more people own this as a traditional asset class. But right now, it's still considered an uncorrelated asset.
Okay, questions are flying in. It takes 10 minutes to confirm a block on Bitcoin, so I'm not sure it's the best coin for transfer payments. I do think it's a great store of value. What do you think?
I agree with you 100%. Bitcoin is a terrible payment system. So the way you have to think about this is Bitcoin is your primary layer. So the Bitcoin's like a savings account. So when we go out and we earn money by expending energy and labor to create value, we have this value that's created and we get paid, and most of us paid in dollars for that value. Well, what are you going to do with those dollars? You have to store them somewhere. You could store them in a dollar, but when inflation goes up 8% or 10% a year, you just lost 8 or 10% of your dollars. That was taken away from you because the government prints more and more dollars. So you really don't want to store your value in dollars because it gets debased. So you need to store it in other things like stocks or real estate or Bitcoin. And when you compare the different stores of value out there, Bitcoin is the best store of value over space and over time because it doesn't dissipate energy like a home does. When you own a home, you get taxed at 2% a year in real estate taxes. So over a 50-year period, you've paid 100% of the value of your home. The Federal Reserve says their goal is to depreciate or inflate the dollar by 2% a year. They're doing a lot more today, but the goal is at least 2. So the value of your dollars won't disappear over 50 years. And so you don't want your hard work disappearing over a 50-year period. So So when you say it's a good store of value, you're 100% right. That's where it's the best store of value. That's where you take your hard-earned sweat and your energy, and you convert that into Bitcoin, and that's the best way to store it over time.
What are your thoughts on countries adopting Bitcoin as official currency? Like, where do you see this going? How do you see that develop?
Yeah, so about 4 years ago, Japan declared Bitcoin was official currency. They were getting prepared for the Olympics, and they wanted a common universal payment system that people could use when they travel to Japan. El Salvador, it's legal tender. Mexico is considering the same thing. And more countries will, adopt, in my opinion, will adopt Bitcoin as legal tender or official currency as time rolls on. And so, right now it's just getting started, but eventually I think most countries will have, some sort of ownership of Bitcoin. A lot of people don't realize, but the US government is one of the largest owners of Bitcoin in the world. So they've gotten most of their Bitcoin through the FBI. The FBI confiscates Bitcoin from people, from criminals, but they've never sold any of that Bitcoin. So they still own it. We just saw billions of dollars of Bitcoin move from the Department of Justice down to a qualified custodian called Anchorage about 6 months ago. And so, we see the government's ownership of Bitcoin on the blockchain. We just don't know how much they, exactly how much they own.
What are the general estimates? Are there any?
Yeah, so I saw this report about 3 years ago, and I haven't been able to find it since. So I might have got scrubbed off the internet, But the report I saw was about the government owns about, through the FBI and the DOJ, owns about 1.5% of the world's Bitcoin.
Wow. Okay, Joseph wants to know if the presentation and recording will be available.
It is. Yep. If you email lp@offthechain.capital, we'll send you a copy of the presentation.
Jim wants to know what percentage of a portfolio should be allocated to Bitcoin.
So like I said, I'm not a financial advisor anymore. We're an SEC registered investment advisor, so I can't give financial advice. But so this isn't financial advice, but I would say a minimum of your net worth, it should be 1% of it should be in Bitcoin. If you get really comfortable with it and you could understand the volatility and you could hold it for 10 years and not sell it for 10 years and just hold it, I don't see, why you shouldn't have 5 or 10% of your net worth in Bitcoin. And just, don't, just buy and hold it. Don't try trading it. The problem with Bitcoin is that when it goes up a lot, you have this urge to sell it because you just made a lot of money. And when it goes down 80%, which it will during the life of your ownership, you want to sell it when it goes down 80%. So you always have this natural urge to sell it because it's going up and down. But what you should do is just hold it. Just hold it for the next 10 years and don't think about it. And in 2032, take a look at it and see what it's worth.
Dave out of Palm Beach wants to know how owning the tokens themselves is different from investing in a fund. What are the advantages?
Yeah, so there are different types of blockchain funds. So if you invest in like a Bitcoin fund, you pay fees to do that. So there are internal fees inside that fund. I don't think people need to pay fees to own Bitcoin. You can go to PayPal, Venmo, Square Cash App, River Financial, Coinbase, and buy Bitcoin directly. Robinhood, buy Bitcoin directly. And you pay a commission to buy it, but there are no management fees to hold it. If you invest in a investment fund in the blockchain space like ours, the goal of that investment fund should be to outperform Bitcoin. And that's what our goal is. Our goal is to outperform Bitcoin, do it with less volatility. We've outperformed Bitcoin 5 out of 5 years since our fund's been around. We've done it with 80% less volatility than owning Bitcoin. But the problem with our fund is that we have $1 million minimum for our investors because we're more institutional oriented.
Your fund mentions a cheap Bitcoin acquisition strategy. Can you talk a little bit about that?
Yeah, so we're one of the largest buyers in the world of Mt. Gox bankruptcy claims. So Mt. Gox used to be the largest custodian of Bitcoin in the world. A Russian hacker broke into the exchange back in 2014, stole almost all the Bitcoin. And the Japanese trustee, it's a Japanese company, the bankruptcy trustee was able to recover 141,000 of the stolen Bitcoin. So the estate is worth about $10 billion. And so if you had Bitcoin at Mt. Gox, you have a claim on that $10 billion worth of assets. And so we buy those bankruptcy claims from people who need liquidity. And what that's enabled us to do over the past several years is buy Bitcoin at an 80% discount to what it's worth. And sometime this year, those bankruptcy claims are going to get paid out. What that means is that we'll actually receive our distribution of Bitcoin sometime this year.
There's a question from Jose. He wants to know about like miners mining Bitcoin from excess energy from energy generators. Do you guys do any of that? What do you think about that?
Yeah, so we made one investment in a mining company, but I've looked at mining companies over the past 8 years, and generally it's better to own Bitcoin than invest in a mining company. So another thing that we do is we buy what are called Hashrate contracts on Bitcoin. So what that is we're buying the miners future Bitcoin from them at a discount today. And that's another way we get discounts on Bitcoin.
Very nice. Let's see. So is your strategy simply access to Bitcoin, or do you do something else? That's Kareem.
Yeah. Our goal is to outperform Bitcoin. So we can't outperform, our fee structure is 2% management fee and 20% of the profit. So we have to outperform Bitcoin by 22% a year just to, meet our goals of outperforming Bitcoin. So we can't own Bitcoin in our portfolio and outperform it. So if you look at our portfolio, about 40% of it is sensitive to Bitcoin through bankruptcy courts, through, Hashrate contracts, to other weird ways of getting Bitcoin at a discount. The rest of the portfolio is invested in blockchain companies that we get at a discount from people who are forced or motivated sellers of equity in blockchain companies. So for example, they may be started at a blockchain company 5 years ago, and they may be millionaires on paper because they have equity in their private company. But if they have to get married, get divorced, have a baby, buy a car, buy a house, they need to sell some of that equity. And so we buy that equity from them at a 30 to 50% discount to what we think it's worth. And then that gives them money in their hands so they can go do what they want to do. And it gives us a undervalued asset that we put in our portfolio.
What are you investing in alternative layer ones? Shamir also wants to know.
Yeah, so we have exposure to Bitcoin through bankruptcy courts and all that. A couple of the other ones that we like are Solana, and Binance is actually our second largest holding, the BNB token. We believe that Binance is significantly undervalued relative to Coinbase and other exchanges that are out there.
So in your fund, you mentioned that you invest in digital asset and blockchain companies. Could you talk about some of the blockchain companies?
Yeah, so one of them is Digital Currency Group. Digital Currency Group is the largest asset manager in the world of blockchain assets. So they own the Grayscale funds. The DCG is the parent company. The subsidiaries are Grayscale, Genesis Trading, which is the largest prime broker in the space, Foundry, which is the largest Bitcoin mining pool in the world, CoinDesk, which is the largest media company in the blockchain space. They have 164 private blockchain companies within there too. If you add up all the value of what we think DCG is worth, it's worth about 40 to 50 billion dollars. And we just bought more shares, closed on them a few weeks ago, and we paid a $12.7 billion valuation. So in our opinion, we got a 70 to 80% discount on what we think the equity is actually worth. Some of the other companies that we own are Kraken. Kraken is actually our largest holding. We started buying that about a year and a half ago at $5 a share, which is $1 billion market value. Today, Kraken trades very actively in secondary markets between $55 and $65 a share, or about $12 billion of market value.
Okay, what do you see as a true catalyst for Bitcoin's true price appreciation?
Yeah, it's just mass adoption. It just takes patience. So last time I say, you should just buy Bitcoin, hold it for 10 years. There's no way to predict the short-term movements of Bitcoin. It's best just to buy and own it for the long term. And so let me put some stats behind that. So if you look at 2021, in 2021, if you take out so there's 365 days in 2021. If you take out 4 of the best days last year for Bitcoin, your return was a negative 1.8% for 2021. So, and Bitcoin was up about 60% last year. So all of the return last year for Bitcoin came in 4 days. So 4 divided by 365 days, that means 2% of the days Bitcoin did really well. The other 98% of the days, it wasn't doing anything. So it's painful to own Bitcoin because 98% of the time it's not doing anything. And if you look over the past 8 years, the data shows the same thing. Over the past 8 years, that's about 3,000 days. 50 of the 3,000 days, Bitcoin did really well. The other 2,950 days, it didn't do anything, and and went down. And so that's the same thing. 2% of the days it did well, 98% of the days it did poorly. And so if you miss those 50 days out of 3,000 days, so instead of averaging 147% a year over that 8-year time period, you only average 7% a year instead of 147%. If you miss those 50 best days. And so that's why I say, just buy Bitcoin, hold it for the next 10 years, don't trade it. 98% of the time, you're gonna feel uncomfortable own it. 2% of the time, you're gonna feel excited to own it, but just own it for the next 10 years.
Okay, so we got a few minutes left. What do you think about Terra buying Bitcoin and companies like Tesla and MicroStrategies? What are your thoughts on that?
Yeah, I think it's a very unique move for Terra to buy Bitcoin and then use their token as the risk asset to offset the Bitcoin purchases. So I think it's great. I mean, it's very creative for them to do that. MicroStrategy, Michael Saylor, who runs that, one of the reasons he is so pro Bitcoin is that he was one of those people that were buying up domain names back in the 90s. So he bought Michael.com, Mike.com, Hope.com, Voice.com, and he sat on them. And he was paying $25, $25, 30 years ago for these domain names. For example, like Voice.com, he sat on that for 30 years. He sold that about 6 to 7 months ago for $30 million.
Wow.
Paid $25 for it, sold it for $30 million, 30 years later. And the same thing's going to happen with Bitcoin. Bitcoin, is 40,000 today. There's 200 million people using it. Our models say that when there's billions of people using this in 8 years, 7 to 8 years, it's going to be worth $10 to $18 million of Bitcoin. So all you have to do is do what Michael Saylor did. Buy Bitcoin and hold it for the next 10 years.
Are you bullish on the Lightning Network?
Yes. So we talked about Bitcoin as being a terrible transactional network. So that's because the blocks clear every 10 minutes, it's slow. It's purposely built like that because the trade-off is safety and security. So what's being built on top of that are layers. And so one of the layers is called the Lightning Network. Lightning Network will make Bitcoin have more, enable it to have more utility, and that will create greater value for the Bitcoin network itself. And so, yeah, I'm very positive on the Lightning Network.
Okay, got 2 minutes left. Can you share with people how they can get in contact with you, invest in your fund, talk about the minimums, all the details?
Yeah, so if you go to our website, offthechain.capital, it's not offthechain.capital.com, it's offthechain.capital. There's a contact form there. You can put in your information, hit submit. Like I said, we have $1 million minimum, and we'll get right back to you. Or you could just email us directly at lp@offthechain.capital, and we'll send you our information.